Disclaimer: this video is created for educational and informational purposes only. It should not be taken as financial, investment, or legal advice. Always conduct your own research or consult a qualified financial professional before making any investment decisions. We all love ETFs. They're simple, diversified, and cheap. The perfect investment, right? But here is what most investors never realize. Even the cheapest ETFs come with hidden costs that quietly eat into your returns over time. Today, we're re-lifting the curtain on those invisible fees, from expense ratios to trading spreads, and showing you exactly how a few cents here and there can turn into thousands lost in the long run. Let's start with the one everyone knows: the TER, or total expense ratio. It sounds harmless: 0.1%, 0.2%, maybe 0.5% per year. Tiny numbers, right? But that number represents how much of your total investment the ETF takes every single year to cover management, administration, and other operational costs. Imagine you invest $10,000 in an ETF with a 0.3% TER. That's just $30 in the first year. No big deal. But if that money grows over 20 years, that 0.3% compounds. You don't just lose $30 a year. You lose the growth that $30 could have earned. Over 2 decades, that can easily cost you hundreds or even thousands of dollars in missed gains. It's like a slow leak in your tire. You might not notice it day to day, but over time, it affects how far you can go. Now here's where things get tricky. The TER isn't the only cost. It's just the visible one. Because when you buy or sell an ETF, you also pay something called a spread. The difference between the buying price, the ask, and the selling price, the bid. Let's say an ETF is trading at $100 bid and a $100, $10 ask. That $0.10 difference might not seem like much, but if you're buying large amounts or trading frequently, those small spreads add up, and they go straight into someone else's pocket, not yours. And here's the catch: the spread isn't fixed. It depends on the ETF's liquidity. Basically, how many people are buying and selling it. The more popular the ETF, the tighter the spread. But if you pick a niche ETF, like one tracking emerging markets or rare commodities, that spread can widen fast. So yes, you might be saving money on management fees, but losing even more every time you buy or sell. Then there's tracking difference, another silent cost. Every ETF is supposed to track an index, like the S&P 500 or the MSCI World. But in reality, they never track it perfectly. Because of management fees, trading costs, and small inefficiencies, ETFs often underperform their benchmarks slightly. That gap, sometimes as little as 0.2% or 0.5% per year, doesn't sound like much, but over time, it compounds. If your ETF earns 7% instead of 7.3%, your long-term wealth trajectory changes dramatically. Over 30 years, that 0.5% difference can mean tens of thousands of dollars lost. Now let's talk about foreign ETFs, the international ones. If you invest in ETFs that hold international stocks or bonds, you might also face currency conversion fees. Your broker or trading platform often takes a small cut every time your currency is converted, maybe 0.5% or even 1% per trade. That means if you're buying a US ETF from Europe or vice versa, you're losing money before you even start investing. And if that ETF distributes dividends, you might also lose a portion to foreign withholding taxes, another cost that most investors never see. All of these little fees, expense ratios, spreads, taxes, conversions, act like sand in the gears of your investment machine. Each one slows down your compounding just a bit, and over time, that adds up. To see how powerful these small percentages can be, let's look at an example. Imagine 2 investors, Sarah and Leo. Both invest $10,000. Both earn 7% a year, But Sarah picks an ETF with a 0.1% TER, while Leo picks one with 0.5%. After 30 years, Sarah's investment grows to about $74,000. Leo's? About $66,000. Same investment, same returns, but Leo lost $8,000 simply because of a small difference in fees. That's the hidden cost of cheap. So what can you do about it? First, always check the TER before you invest. It's listed on every ETF's fact sheet, usually found on the provider's website, like iShares, Vanguard, or SPDR. Aim for ETFs below 0.2% if possible. Second, pay attention to liquidity. Choose ETFs with high average trading volumes and tight bid-ask spreads. A difference of just a few cents per share can make a big impact if you're investing regularly. Third, check the tracking difference, not just the TER. Some ETFs have a low official expense ratio but still underperform their index due to poor execution or internal costs. Fourth, consider your brokerage costs. Even if ETFs are cheap, if your platform charges $10 or $15 per trade, that's eating your returns, especially if you invest small amounts often. And finally, remember this: low-cost investing only works if you actually keep it low-cost. That means avoiding overtrading, chasing new ETFs every few months, or switching between platforms for small gains. The less you move, the less you pay, and the more your money compounds. The beauty of ETFs is that they give you access to entire markets for almost no effort. But understanding the small print, the fees, spreads, and hidden costs is what separates smart investors from average ones. Because in investing, the real secret isn't about chasing higher returns. It's about keeping more of what you already earn. So the next time you look at that low-cost ETF, ask yourself, is it really low-cost or just low fee on paper? If you enjoyed this breakdown, hit like, subscribe to Money Mindset, and turn on notifications. We post new videos every day to help you make smarter financial decisions. And tell us in the comments, did you ever discover a hidden fee in one of your ETFs?